Yes, indeed. Welcome back. Jimmy at the Crossroads, coming to you in partnership with the Washington Examiner. Nathan, I was wondering where that applause was going to be, brother. Thank you so much. Nathan Matoush, producer extraordinaire, working the Matoush magic once again here on Jimmy at the Crossroads. Be sure to subscribe to the YouTube channel if you have not done so already. Folks, Joe Biden, our President of the United States, has an economic plan. He's going to be speaking, by the way, in his first address to Congress and the nation simultaneously this Wednesday night, in which he will certainly talk about his economic plan. And by way of introduction for our guests, I will want in a moment to play a clip that will take us down memory lane to 2019 during the campaign and what President Biden, then candidate Biden, said about taxes and what he would like to do, especially on the capital gains tax, as well as something Jen Psaki said as the press secretary, I think just yesterday about his proposals, just last week about his proposals. But first, let me introduce our guests here on Jimmy at the Crossroads for today's Crossroads panel. In the center, Rick Newman. He is senior columnist at Yahoo Finance, where he also hosts programs on their web shows. And we've got Chris Edwards. He is Director of Tax Policy Studies at the Cato Institute and also heads up downsizinggovernment.org. Gentlemen, welcome to the show. It's so good to have you.
Thanks, Jimmy.
Thanks. Happy to be here.
There we go. So we give applause to the guests as well. We do appreciate it.
Oh, what a great mix, I said. Gonna talk money, gonna talk politics. I got Jimmy at the Crossroads, making sense out of nonsense. People want answers.
All right, gentlemen, I want to dive right in by playing cut 4. This is President Biden, then candidate Biden, on the campaign trail, well, during a debate, pitching his idea of a tax increase, and then Jen Psaki, the press secretary, talking about that just last week.
We need to go out and make it clear to the American people that we are going to raise taxes on the wealthy. We're going to reduce tax burdens on those who are not. We have to start rewarding work, not just wealth. I can pay for my whole health care plan by changing the way in which we deal with capital gains. People should pay their capital gains based on what their income tax is, and not at 20%.
Well, the president's proposal for the American Jobs Plan was about modernizing and making a historic investment in our infrastructure. The tax component was about how to pay for it. We're very open to a range of options, and he has some lines in the sand we've talked about, including not having the American people pay for it, or not being on the backs of the American people. It relates to the capital gains rates and the top margins that you've seen reported out there, the president's bottom line is that people making under $400,000 a year will not have their taxes go up. So if you look at these proposed numbers, which are consistent with what he talked about on the campaign trail when he was running for president, what I can say is that it will only affect people making more than $1 million a year. That's 0.3% of taxpayers, or 3 out of every 1,000 taxpayers. That's even as the top 1% saw their net worth rise by $4 trillion in the middle of a historic pandemic. So he has some bottom lines of where he will not budge fast, right, on individual numbers and who will be impacted, but he's also open to discussion.
Let's dive right in. Rick Newman, it sounds like President Biden is following through on something that he promised during the campaign. What does his plan entail, and what's your overall take on it?
Yeah, there's no surprise to any of this, although the market seems to have been caught by surprise, at least for a day or two. But Biden said he was going to raise taxes to pay for a lot of building plans, social welfare plans, and other things. And now he's rolling out the blueprints for those. And of course, Congress makes the legislation. So the pattern we're seeing is Biden publishes the plan. He's done that with the so-called American Jobs Plan. That's going to be the big infrastructure plan with some climate programs in there. And then that's going to be followed apparently very soon, perhaps this week, by what he calls the American Family Plan, more like social welfare spending. And he's coming up with, tax hikes to pay for this. And it's exactly what he said he was going to do when he campaigned. I have not noticed any single thing Biden has said as president that he did not say he was going to do as a candidate in terms of raising taxes. he's not going to get all these tax hikes he's talking about. They're not going to come in. Congress is not going to pass them at the level he's asking. I think it's safe to say Biden knows that. But he's making his ask. He's fulfilling his campaign pledges, and he's probably going to get about half of what he's asking for from Congress in terms of actual tax hikes.
Chris Edwards, with some of that in mind, I mean, clearly President Biden talked about these things on the campaign trail. In fact, back in October, you wrote a blog post and a commentary article saying why the capital gains tax he was proposing, which now the administration is formally talking about, was a bad idea. Your thoughts to kick things off?
Yeah, I think I agree with Rick that Biden did promise this stuff. He's now following through on. However, there are giant contradictions here. So his $2 trillion infrastructure plan would be funded by roughly a $2 trillion corporate tax increase. But much of his infrastructure would be vast subsidies to the private sector, such as broadband, electric vehicle companies, manufacturing companies. So he'd be raising corporate taxes, which would reduce the incentive for private companies to invest at the same time as he'd be giving these corporations these subsidies. So, for example, America's broadband companies like AT invest over $50 billion a year in internet infrastructure and broadband. Well, that's great. And Biden would give them more. He would give them $100 billion more subsidies for broadband. But at the same time, he'd raise corporate taxes so that AT&T has to pay a lot more corporate tax, which would reduce their incentive to invest. It's the same with electric vehicles. You know, GM is promising to spend $27 billion on electric vehicles in coming years. Well, that's great. But then Biden would raise the corporate tax on General Motors, and that would reduce their incentive to invest. So there's this giant contradiction in the Democratic plan. And another related contradiction is that, you know, the Democrats and Biden himself campaigned against corporate subsidies. They claim that Republicans hand out corporate subsidies, and frankly, they do often. But you know, many leading Democrats, Bernie Sanders and Biden himself, say they're against corporate subsidies or corporate welfare. But the infrastructure plan itself is a massive corporate subsidy plan. So I think the Democratic Party's got to really figure out what it's for here.
That's interesting. Rick Newman, what do you make of the infrastructure side of the equation? We'll get to taxes in a moment, but in terms of infrastructure, this idea of providing the projects in a way that Chris is laying out.
The way I think about this is, even though it might not be labeled this way, we're having a big debate about whether we should adopt industrial policy in the United States. I have capitalist leanings and free market leanings. You should, the free market should sort this out. However, China has industrial policy, and they are using industrial policy, for example, to subsidize vehicle electrification, and they're leading in vehicle electrification. Europe clearly has different types of industrial policy. And I'm not saying that is the best solution for the United States, but I think Biden is actually right when he outlines the technologies of the future and the industries of the future where we want the United States. It is in the U.S. national interest that the United States has the lead, has the companies, has the factories, and has the workers. And I think we have enough evidence from globalization during the last 25 years that if you just leave it up to the corporate sector is fantastic at efficiency, but efficiency often means we don't make it here. I mean, we saw this in spades with protective medical equipment during the coronavirus pandemic. So I don't see a neat outcome here, but I think there is some merit to discussing whether we really do need to have more of a deliberate industrial policy in the United States.
Chris Edwards, Director of Tax Policy Studies at the Cato Institute. What do you make of Rick Newman's point about the idea that maybe what Biden's doing will just help us make us more competitive against a country, say, like China?
I think what Biden is proposing would actually make us less competitive. I agree with Rick. I'm concerned that, that America lead in these industries of the future, but I think what Biden is proposing would do the opposite. So, for example, the U.S. corporate tax rate, if you add state taxes on now, we're at around 27%. Well, that's already higher than China with a 25% corporate tax. And the average rate in Europe is only around 20%. So, when you get car companies thinking about where they want to locate their next factory, whether it's a traditional car factory, a new EV factory, we want them to locate that new factory here in America. And the way you do that is have a very inviting and competitive low corporate tax rate. And another thing that Biden is proposing is he wants to tie labor union regulations to all his flows of federal money. He's saying he wants labor unions involved in all his new infrastructure, his EV activities, his manufacturing subsidy activities. I think that'll raise costs for American producers and again induce American producers to move their production offshore. So I think the way to get production here in America, to get the industries of the future, whether it's EVs, whether it's solar panels, whether it's windmills, is to have a very inviting business climate and induce the American businesses and foreign businesses to invest here because it's the best and most efficient place for them to set up factories.
And what Chris is saying is rational and sensible. The question I would have, though, is, so we did not have a long experiment in doing exactly what you just recommended, Chris, but we had a short experiment. Trump did do most of those things, well, many of them anyway, with the 2017 tax cuts, which were in effect for 2018 and 2019. And then I think 2020 is a write-off because of the coronavirus pandemic. But we did not see a material increase in non-residential fixed investment, for example. That is, we were supposed to see a big increase in business spending in the United States, and it didn't happen. So are you saying we should go back to the sort of low tax environment Trump had, or in other words, leave it in place? Or should we add something to that as a further inducement? Because Trump's approach doesn't seem to have changed very much.
Well, I mean, I think there's a lot of forms to make America a more attractive place for business investment. One of them is the corporate tax, but another is labor union regulations and environmental regulations and our education policies and that sort of thing. But corporate investment plans are very long term. I mean, when a Intel Corporation's thinking about building a new semiconductor factory, it's thinking long term. Or when Tesla is thinking about where to build its new car factory, these are long term investments. I think the Trump corporate tax cut was a step forward. Wages did rise in the couple of years that his corporate tax cut were in place. You're right, there wasn't a giant boost in infrastructure and investment, but it didn't fall also. I think it was pretty solid, and it did extend the U.S. economic expansion. I think we all agree that, corporate investment is very elastic. It's very mobile. You can put a car factory, a semiconductor factory anywhere in the world today. And, these companies, whether it's Intel or Apple, they decide at the margin, where the best place to locate their next factory is, and then they can ship the products anywhere in the world. So I think policymakers have to think how corporations think. We have to go to corporations and think, I don't want special favors for corporations. I just want low, equal rates for everyone to encourage them to do their long-term investment here in America.
Rick Newman.
So that's the economics of it. I just want to introduce a political element. So as a percentage of, whether you want to measure it as a percentage of GDP or as a just percentage of all federal revenue, corporate tax revenue is at record lows by both measures. And it almost is a non-functioning tax at this point. I mean, the amount of money that comes in from the corporate tax is relatively small relative to the federal budget. So that bothers people. I mean, that is a kind of a political problem, and it has contributed. It's one of the reasons the Trump tax cuts were unpopular on balance, because people think those tax cuts favored businesses and the wealthy too much, and they don't feel that businesses and the wealthy are doing their fair share. I'm not saying they are or they're not. I'm saying it actually is an effective political argument, which I think actually worked for Biden in 2020. Polls show majorities support higher taxes on businesses and higher taxes on the wealthy. So there is even if the economics might argue against that, you do have to address this political problem that it just doesn't look right.
So I do want to shift into the tax revenue standpoint. And Rick, please, or Chris, please speak specifically to the corporate income tax, and go ahead and make your point as well.
Yeah, Rick, you may look up on the Cato blog. I looked last week at the big industrial countries, and I looked over time since 1980 at what's happened to their corporate tax rate and then what's happened to the corporate tax revenues. Well, corporate tax rates have fallen around the world, as you may know. Interestingly, corporate tax revenues overall are actually up over the last few decades. We have lower rates and higher revenues. And so what has happened? Corporations are investing more, but also they're cheating less. They're avoiding taxes less. I think you're right. The public certainly doesn't like it when corporations get special treatment, when they're cheating, when they're moving profits offshore unfairly. But I think when you have a high rate, you induce the corporations to cheat, to move their profits offshore. You're right, corporate tax revenues were down in the last couple of years, but I think in the long run, if you have a low and competitive rate, you get more investment and you get less cheating, and I think those profits will come back, and then I think the government wins as well as businesses will win and workers.
Rick Newman, you can respond to Chris Edwards, but Rick, I do want to ask you to also talk with what Chris was just saying in mind about Biden's proposal to raise the corporate tax rate.
Well, his proposal is to raise it from 21% where it is now to 28%. And there are a few other changes for different types of corporations. It was 35% before the 2017 tax cut law. So Biden wants to bring it halfway back to where it was. And he's probably not going to get 28% because of Democratic Senator Joe Manchin and a few other moderate Democrats who say that's just too high for businesses in their state. But I think he's going to get 25. I think the business tax rate is either going to go up to 25% or 26%. Is that a good thing or a bad thing? I mean, I follow the arguments on both sides. I mean, could it lead to more tax evasion or offshoring or whatever unintended consequences? Yes. But on the other hand, if you look at the stock market surely did fine when the tax rate was 35%. And investors know the corporate tax rate is going to go up. The investing professionals we have on Yahoo Finance all the time think the market understands this and it's close to priced in. So you're not seeing an adverse reaction in the stock market. So I think that tells you it would probably be okay to raise it up to 25%. I do think the corporate tax is just kind of broken. Honestly, it raises so little revenue on a relative basis. It seems like we're arguing about it more than we should. And maybe we shouldn't have a corporate tax at all. Maybe we should have a shareholder tax, or maybe it's time. I mean, eventually, I think we're probably going to end up with a value-added tax, which might replace everything we're talking about. But for now, we're probably just going to limp forward with a corporate tax that's a little bit higher starting in 2022 is my guess.
So I want to jump over to the capital gains tax now. And Chris Edwards, your thoughts on this, because President Biden has suggested a massive increase in the capital gains tax rate for those making above $1 million. What does his proposal entail and your sense for it, sir?
So the United States is nearly always, since we put an income tax a century ago, had lower rates or special treatment for capital gains because they are different from ordinary income. So Biden would roughly double the federal capital gains tax rate from around 20 to 40%. I don't think that's a good idea. I think a low capital gains tax rate is crucial for high-tech investment and investment in startups and new companies. If you think about Silicon Valley, the payoff to angel investors and rich people who invest in new startup businesses is they wait years for a payoff. These are very risky investments. A lot of them don't pay off. But the investments that do pay off, the investors get a big capital gain. And I think if you increase the capital gains tax rate, more American investors will put their money into safer investments like muni bonds and that sort of thing. So I'm really worried about the impact on Silicon Valley, and I'm curious what Rick's view is. I'm wondering why Silicon Valley sort of isn't up in arms about this. Investors, whether it's folks like Elon Musk and Bill Gates, they put a lot of their money into startup businesses, and this is why there's such dynamism in Silicon Valley. Aren't they concerned about rising capital gains? And if not, why not? I think it's a bit of a mystery here why Silicon Valley is not more concerned about this proposal.
Go ahead, Rick.
Well, I'm waiting for Mark Zuckerberg and Tim Cook to call me back on that. So when they do, I'll get back with you guys. So I accept the principle that if you tax something, you're going to get less of it. So if you tax investing, you might get less of it. But then if you just kind of just do a sort of ground truth. Just ask yourself a ground truth. So if the return on investing goes down a little or even a lot, it doesn't mean you're going to stop investing. It means you will invest in something else, but only if you can get a higher rate of return. So I think a question we don't know the answer to is it possible that, I mean, we've just seen an utter boom in startups, and now we have SPACs and crypto startups and non-crypto, everything. We have an everything boom right now. So is it possible that returns are so high that you can actually lower those returns and they're still higher than historical averages? I don't know. But, I keep coming back to the alternative. Somebody needs to explain the alternative. So even before Biden's plans, we had very large budget deficits. We were spending way more than we were taking in revenue. And let's say you don't need to balance the budget every year, but I think deficits were too high on a chronic basis. So if you need money just to deal with your debts, and then you say we need to invest in the future, where is the money supposed to come from? It's, politically, it can only come from the people who have the money. I mean, there is just no political answer that gets you to, we're going to tax the middle class more because we don't want to impinge on investment. That might be economically valid, but it is politically a non-starter. So where do you want to get the money?
Chris,
I just don't
go ahead
know
and
where
respond
else
to Rick. But first,
the other argument is just maybe
Sure.
we just don't invest in anything.
I want to ask Chris to respond to that, but also when it comes to incentives and when it comes to raising taxes on capital gains, and maybe it won't reduce investors' desire to invest, but what kind of incentives are there for possible changes in how they actually go ahead and invest, whether or not they take risks in new startups as much and what have you?
I mean, the first thing I would say, look, I would say let's not break what is broken. I mean, Silicon Valley has been a huge powerhouse for America for decades. In my view, partly based on our low capital gains tax rate. I would note that just about every major industrial country, just about every European country, they have a much lower capital gains tax rate than their ordinary tax rates for that reason that I was talking about, because they want their high-tech industries to succeed. So I'd say let's not risk it. The capital gains tax rate hardly raises any money for the federal government. That's you're not going to raise much money, if any, by raising the rate anyway. Rick mentioned, so where are we going to get the money for investing in these industries of the future? Well, that's up to the private sector. For most infrastructure in America is owned by state and local governments, and state and local governments have shown they're quite willing to raise money for their own highways, their own transit systems, and that's fine. They should do it. State and local governments should raise their own money for their own infrastructure. The federal government owns very little infrastructure, so infrastructure is mainly not a federal responsibility or priority. So where should I think I agree with you. I'm concerned about deficits. I think there's a lot of places we can cut, and a lot of these are outlined at the Cato Institute's website. I mentioned corporate welfare subsidies earlier. There's a lot of corporate welfare subsidies in the federal budget that we can cut, and I think we should cut. I think that'll help Americans understand that there's some fairness here, that we do eventually need to balance our budget. So let's cut the current subsidies we have for businesses, such as big corporate farms and that sort of thing. But I don't, we're not going to get the revenue you need to balance the budget from the capital gains tax. It hardly raises any money.
Well, and Rick Newman, to that point, I want to bring in, this is a very interesting op-ed yesterday in the Wall Street Journal. You may have seen it, by Lawrence Lindsay. He served as a Federal Reserve governor from 91 to 97. He wrote this on the revenue implications. What makes this unusual, that is Biden's proposal to potentially raise the capital gains rate on those making $1 million or more to 43.4% when you add the capital gains Medicare tax to it. What makes this unusual is that the 43.4% is well above the rate that would generate the most revenue for the government. Congress's Joint Committee on Taxation, which does the official scoring and is no den of supply-siders, puts the revenue maximizing rate at 28%. My work several decades ago puts it at about 10 points lower than that. That means President Biden is willing to accept lower revenues as the price of higher tax rates. The implications for his administration's economic thinking are mind-boggling. To Lindsay's point, Rick Newman, Would raising the capital gains tax rate this much on higher income earners actually result in more revenue to the federal government?
I don't know. I don't think anybody knows. I did see that. So he said he cited research showing that the optimal rate would be around 28% rather than 40%. I think that's what we're going to get. I don't think we're going to get 40%. I think we're going to get something like 28% for the same reasons we talked about before with the corporate tax. One other thing I would add, I mean, I've seen all the fulminating about, oh my God, wealthy people in California, New York could end up paying, it could be upwards of 50% when you factor in, state and local capital gains taxes. I guess that's if you make a lot of capital gains and you don't have a lawyer and you don't have an accountant and you just fill out your form and you pay whatever the government owes. We just had the IRS commissioner significantly raise the estimate for the so-called tax gap, which is the amount of tax that people owe the government, but the IRS can never find and never collect, to $1 trillion a year. I mean, these tax proposals that Biden is talking about, I mean, these might raise 20 billion per year or 40 billion per year. And the IRS commissioner is saying there's $1 trillion per year that goes uncollected. So I have a hunch that some of that $1 trillion is those people who might be paying 50%. I don't think anybody would end up paying 50% because that's what great tax accountants and great tax lawyers do. So yes, 43.4 on paper, perhaps more than 50 all in on paper. I'd be astonished if anybody was so foolish to ever pay that.
Just a few minutes left with our guests, Rick Newman, senior columnist at Yahoo Finance, and Chris Edwards, director of tax policy studies at the Cato Institute. Chris, how about the potential for tax evasion and so forth, and what Rick Newman is talking about in terms of how the wealthiest would be responding to a potential tax increase in reality, potentially?
Well, the way I think about it is that tax rates and the tax base move in different directions. If you move tax rates too high, especially higher than other competing economies, then the tax base will shrink. There will be more cheating. There will be more avoidance and offshoring of revenues by corporations and wealthy people. So, I think the first thing is you need some reasonable rates so that people are induced to report all their income. And then close. I agree with Rick. We should close loopholes. I mean, one loophole that rich people have long had that I would be in favor of closing is that municipal bonds are completely tax-free. So one of the things that's going to happen if you raise the capital gains tax rate, a lot of wealthy people who now invest in startups, which I think is a good thing, they're going to move their money to tax-free municipal bonds. It's true the yield is lower, but at the margin, they're going to save a lot on taxes by investing in muni bonds. So that is one loophole that I would agree to close. So I think tax wonks on the left and the right. There are some reforms here that we could probably all agree with. Another one, the Republicans in the 27 tax bill put a cap on the state and local tax deduction. I think that was a good move. I think that was a loophole that should be closed, and I would repeal that altogether. The idea here is to have low and reasonable rates, in my view, and close the loopholes. And I think the government and its revenues will do just fine.
Overall, final question for you gentlemen on the substance here. Rick Newman first. When you look at Biden's plans, what do you think we will actually get in reality as far as an infrastructure package coupled with potential tax increases? And does it pass Congress perhaps through reconciliation?
I think the tax increases, I've said this before, are generally going to be about half of what Biden is asking for. And in terms of the infrastructure package, I mean, we're going to get a big infrastructure package. So Biden's asking for close to $2 trillion. Republicans came out with an alternative package that was between $600 and $800 billion, I think. So if let's say $600 billion, if that's the floor, we could get $1 trillion, and Democrats in the White House might sound disappointed because it's only half of what they want. That would still be a very large infrastructure package. I think the question, and we won't know the answer to this for years, but are they going to be spending it on the right things? Will it be investment that generates a return, or is it just going to be spending on programs? I do feel like we need some at some national level. We need to have a way to prioritize what we need to do for the next 20 years in these critical fields we've been talking about. And yes, Infrastructure spending mostly comes from the private sector, but there is no single corporation, there is no single corporate entity of any kind who is concerned, number one, about what's in the national interest. Every company's job is what's in their own shareholders' interest. State and locals, they cannot plan at the national level. The only institution that can plan at the national level is the federal government, like it or not. So it does feel to me like we do need some federal guidance in terms of, getting ready for the next 25 years and make sure we do remain the leading economy.
Chris Edwards.
I'd question that idea that the federal government is able to plan, even if there were Washington is full of angels. I think that they would misdirect a lot of investment. To give you one good example, Rick, is Amtrak, which consistently runs large deficits. Amtrak, makes sense in the Northeast Corridor, Washington and Boston. It can earn profits there, but on many of its long-distance routes around the country, it loses massive amounts of money. Passenger rail doesn't make sense in a lot of those places, and yet because there's a lot of power from rural states in Congress, Amtrak directs its money to low-value investments where we don't need it. It's the same with airports. A lot of federal airport money goes to airports that don't need extra investment, and it starves investment money from the biggest airports that need the most investment. So I don't think federal government investment is very efficient. And the last word about the Biden plan is I don't think a very big plan is going to pass. I think a lot of these internal contradictions in the plan will become more evident in the months ahead. Like I said, this is a massive corporate welfare bill. A lot of Democrats say they're against corporate welfare. So I think the Democrats really need to figure out where they are on that. And a final point is a lot of the way Biden funds his plan is not green. The green way to fund infrastructure is through user charges. Charge water users more money if you need money for investment. That reduces their water usage. That's green. But that's not what Biden does. Biden hands out a lot more subsidies from Washington, which is not a green way to fund infrastructure. So it's not going to help climate change on the funding side.
Gentlemen, I could keep going at this for ad nauseum. We could just keep talking because you guys are so insightful and thoughtful. Rick Newman, Yahoo Finance senior columnist. Chris Edwards, director of tax policy studies at the Cato Institute, also oversees downsizinggovernment.org. There we go. More applause from Mr. Matoush. Thank you both so much. What a great discussion, and I look forward to many more as these issues get sussed out. Thank you.
See you guys.
Thanks, Rick and Jimmy.
Once again, Rick Newman, senior columnist at Yahoo Finance, and Chris Edwards at the Cato Institute, director of tax policy studies. They're joining us here on Jimmy at the Crossroads. My bottom line, you probably will not be surprised to know that I line up more with Chris Edwards on this because I think we should eliminate the corporate tax and eliminate the capital gains tax and the dividends tax. I think that there are a lot of taxes on business that are much more harmful to the economy and to economic growth. But of course, I also live in the realm of reality and consider what is possible. And the biggest thing that's possible right now, I think, is to stop what's happening in terms of these potential tax increases and the massive infrastructure spending effort on the part of President Biden. I think we need to pull back the curtain for the American people on the real consequences of these things, in terms of what the revenue gained may actually be, in terms of how the economy will be affected, in terms of restricting business investment and so forth. Those are things we really need to be talking about. But I thought that was a fantastic discussion. These are two excellent individuals who really have some tremendous insights. So my thanks to Rick and Chris for joining us.
Talking politics, great for generations. Oh, what mix. I got Jimmy at the crossroads, making sense out of no sense. Yeah.